The slave trade wasn't just about plantations. It was the world's first massively securitized industry, with bonds backed by human bodies trading on Wall Street. This wasn't hidden in shadows. It happened openly in downtown Manhattan, documented in ledgers that still exist today. American banking was built on the systematic financialization of human suffering. Welcome to Money Stories, where we uncover the hidden histories of finance and expose how economic systems shape human destiny today. We're examining how New York banks created the first mortgage-backed securities using enslaved people as collateral, and how this brutal financial innovation became the blueprint for modern investment banking. Most Americans believe slavery was primarily an agricultural system, wealthy plantation owners in the South buying enslaved people to work fields. This narrative is incomplete and deliberately misleading. Slavery was never just about agriculture. It was a financial system, a banking system, an investment system. Northern merchants and bankers grew wealthier from slavery than Southern plantation owners did. They financed slave voyages, bought and sold enslaved people as commodities, insured slave ships, and most importantly, created financial instruments that allowed investors to profit from slavery without ever owning plantations. The mechanics were sophisticated and eerily similar to modern securitization. A slave trader would borrow money to purchase enslaved people in Africa. The trader would transport them across the Atlantic, a journey that killed roughly 15% of the captives and sell the survivors in America. The trader would then use those sales to repay the loan. But traders needed capital to finance voyages. They couldn't wait months for voyages to complete and sales to occur. They needed immediate liquidity. The solution was a financial instrument called a bottomry bond, essentially a loan secured by a ship and its cargo. A merchant in New York would lend money to a slave trader, taking a bottomry bond as security. If the voyage succeeded and enslaved people were sold, the bond was repaid with substantial interest, often 20 to 30% annually. If the ship sank or the voyage failed, the lender lost the investment. But insurers quickly emerged to guarantee these bonds, allowing lenders to eliminate risk entirely. This created a market in enslaved people, just like modern mortgage-backed securities. These instruments separated the original lender from the risk. A New York banker could lend money to a slave trader, then sell the bond to another investor. The original banker had recovered capital with a fee and no longer held the risk. The new investor held the security backed by enslaved people's labor and suffering. This allowed capital to flow continuously into the slave trade, without any individual investor having to stay in the business long term. The scale was massive. Historians estimate that between 12 and 15 million enslaved Africans were forcibly transported to the Americas. Roughly 2 million of them came through New York. The financial flows were staggering in the peak years of the slave trade. The equivalent of hundreds of millions of dollars in modern currency flowed through New York's financial markets annually. This was the largest securitized market in the world at the time. New York banks weren't passive participants in this system. They actively created it, encouraged it, and profited enormously from it. The Bank of New York, founded in 1784, was explicitly involved in financing slave voyages. The bank's founders included merchants who directly engaged in slave trading. Alexander Hamilton, the bank's first cashier and later Treasury Secretary, had direct ties to slave trading merchants. Hamilton himself never personally enslaved people, but he built the financial infrastructure that enriched slave traders and made slavery the most profitable industry in America. The mortgaging of enslaved people was particularly brutal. Plantation owners would borrow money using their enslaved workers as collateral. A planter with 100 enslaved people could borrow money, with the enslaved people's bodies literally serving as collateral. If the planter defaulted, the lender could seize the enslaved people. This created a market in enslaved people's bodies as financial assets. They could be bought, sold, mortgaged, and insured just like any other commodity. Insurance companies emerged specifically to insure enslaved people. An owner could take out an insurance policy on an enslaved person, and if that person died, the owner would receive compensation. This created perverse incentives. Owners could profit from enslaved people's deaths through insurance payouts. Some historians have documented cases where owners allowed conditions to deteriorate. Knowing they could recover losses through insurance, the system transformed human lives into financial instruments where death itself became a profit opportunity. New York merchants created what they called Negro insurance, specifically to insure enslaved people's lives. The policies were straightforward: pay an annual premium, and if the enslaved person died, receive compensation. The policies were traded like any other security. Investors could buy and sell insurance policies on enslaved people they'd never met, had no direct relationship with, and would never see. This was pure financial speculation, built entirely on human suffering. The connection between slavery, finance, and modern banking is direct and documented. Many of the major investment banks operating today have roots in slavery financing. Morgan Stanley, Deutsche Bank, and others have acknowledged historical ties to slavery financing and have apologized. But the apologies obscure the deeper truth. Modern investment banking's fundamental structure was invented to finance slavery. Mortgage-backed securities, the financial instrument that precipitated the 2008 financial crisis, emerged directly from slavery financing innovations. The basic structure is identical. Borrow money to purchase assets. Use those assets' future productivity to secure bonds. Sell the bonds to investors and collect fees. In slavery, the assets were human beings. In 2008, the assets were mortgages on houses, but the mechanism is the same. The only difference is the asset class. The separation of risk from responsibility is the key innovation that slavery finance contributed to modern banking. In medieval times, a lender had to directly know and assess the borrower. If the loan went bad, the lender lost money directly. This limited lending to amounts people could actually afford to repay. Slavery financing eliminated this constraint. A banker in New York could lend money to a slave trader in Africa, sell the loan to investors in London, and have zero exposure to whether the loan was actually repaid. Risk was transferred through financial layers. The original lender profited, investors bore the risk, and the fundamental incentive to make prudent loans disappeared. This is exactly what happened in the mortgage market before 2008. Banks made loans to borrowers with no ability to repay, bundled the loans into mortgage-backed securities, sold them to investors, and had zero exposure to losses when borrowers defaulted. The system incentivized reckless lending because lenders profited regardless of whether loans were repaid. The 2008 crisis was built on the same structure that financed slavery, the separation of risk from responsibility. New York's financial dominance during the 19th century was built substantially on slavery wealth. The city became the financial capital of the world, partly because slavery capital flowed through it. Cotton plantations in the South were financed by New York banks. Slave ships were insured by New York companies. Enslaved people were sold through slave markets in New York. The financial networks that emerged to handle this massive flow of capital formed the foundation of modern Wall Street. The wealth accumulated from slavery persists in America today. Estimates suggest that slavery generated roughly $10 to $12 trillion in unpaid labor value. This wealth was seized by slave traders, plantation owners, and the financiers who enabled the system. Much of that wealth was reinvested in northern businesses, railroads, factories, and banks. The institutions and families that grew rich from slavery used that capital to build the industrial and financial systems that dominate America today. The descendants of enslaved people received no compensation. They inherited only the intergenerational trauma of slavery and the structural racism that emerged from slavery. Meanwhile, descendants of slave traders and slave financing bankers inherited wealth that was built on slavery. This explains much of America's persistent racial wealth gap. Black Americans have roughly 1/10 the median wealth of white Americans. This gap traces directly to slavery and the centuries of discrimination and exclusion that followed. The gap persists not because of anything inherent, but because of historical policies and systems that systematically extracted wealth from Black Americans and transferred it to white Americans. The financial innovation that enabled slavery is still embedded in American banking. The principles of securitization, the separation of risk from responsibility, the transformation of people and assets into financial instruments, these remain central to how modern banking operates. The only difference is that slavery explicitly involved human beings as assets. Modern banking involves mortgages, bonds, derivatives, and other financial instruments. But the underlying logic is the same. Transform something of real value into a financial security, transfer it through layers of intermediaries, and extract profit at each layer. Understanding this history is crucial because it reveals that America's financial system wasn't built on innovation and efficiency. It was built on the systematic exploitation of enslaved people and the financialization of human suffering. The wealth that built America's financial dominance was stolen from millions of enslaved people through a brutal system of forced labor and financial innovation. This history isn't just academic. It explains current inequalities, current injustices, and current financial structures. That's the story of how slavery built modern investment banking, and how the financial innovations created to profit from human suffering became the foundation of Wall Street. If you found this exploration of hidden financial history disturbing and important, subscribe to Money Stories for more uncovered truths about how finance has shaped human history. Leave a comment below. What do you think America owes to the descendants of enslaved people for the wealth stolen through slavery and slavery finance? Thanks for watching Money Stories, and I'll see you in the next episode.